last year everything was looking quite fine and dandy up until the end of September. Markets were generally ahead for the year. Bond yields were up, reflecting sort of general optimism about economic growth. And then, of course, in the fourth quarter, we saw a lot of risk aversion. Equity markets fell sharply in both October and December. Bond yields fell sharply. There was a flight to safety, and commodity prices too fell sharply. And I suppose it's always quite hard to assign a reason for this sort of behavior. I suspect some of it related to the fact that you'd had a little bit of unusual performance in markets leading up to September. The US had done very well, and that was largely on the back of a fairly small number of tech stocks, the so-called FANGs, Facebook, Apple, etc. I think also, there was a feeling that the tax cuts that Donald Trump had introduced at the end of 2017, those had led to a little bit of overheating in the US economy, and the new Fed governor was adamant that he was going to sort of nip any inflationary pressures in the bud. And so there was talk about, more interest rate increases last year. And so the fourth quarter comes along, and perhaps people realize that maybe things weren't quite as rosy. I suppose the big question is, was what happened in the fourth quarter the start of a bear market, or just a correction? So as far as the trust's investment performance last year is concerned, it was quite a tough year because of really what happened in the fourth quarter, and this poor performance of equity markets. Also, the performance of mid caps that the trust holds. Mid caps underperformed in relation to large caps, and that also impacted the trust. But in relative terms, relative to the peer group, the trust actually had a very good year, and that was largely because of the successful listing of AJ Bell in the fourth quarter. We were one of two outside shareholders in AJ Bell before it was listed, and then subsequent to the listing in early December, the shares performed very well, and that helped the performance. But also, we started to move the positioning of the fund to a more defensive position some time ago, and given the market performance in the fourth quarter, that positioning helped. So although in absolute terms the performance wasn't great, certainly in relative terms the trust had a very good year. So as I said earlier, I think one of the big questions is, were the falls in markets in the fourth quarter the start of the next bear market, i.e. something more pronounced and prolonged, or were those falls simply some sort of correction following a few months of strong performance in certain parts of the equity market? My view, and I may well be wrong, but my view is that actually the falls were just a correction, and that we've still got some time to go before the next downturn, before the next bear market. And my reason for thinking that is that actually, if you look at global monetary policy conditions, liquidity conditions, they're still very supportive. Even though we've had interest rate increases in the US, according to the Fed governor, we've only recently moved from conditions being accommodative to being neutral. We haven't even got to the stage where they're tight. In other areas, we've only had 2 interest rate increases in the UK. And then in Europe and Japan, we haven't had any interest rate increases. So if you look at conditions globally, I think monetary policy is still loose. And that should mean that the global economy remains reasonably well supported for some time to come. You've also got inflation that, while it's been rising over the last few years, it has started to moderate a little bit. And whilst the underlying inflation pressures are still quite strong, namely wage growth is still rising, you've probably got a little bit more time before those wage pressures really start to feed through to headline inflation, and before the point where economies really overheat. And it's really when economies start to overheat, that's when you normally get a downturn, and that's when you normally get a recession. So I think we're still some way off from that. As far as what the trust is doing on the asset allocation front, it's more of the same. We've been gradually decreasing the equity weight in the trust, and the expectation is that we will continue to do that as we progress towards the end of the cycle, which, as I said, we still think is a little way off. I suppose the way I would frame it is that a recession has probably just come into view over the horizon, but it's going to be a little bit of time before the ship reaches the harbour.
One of the key ones is that probably the size of the AUM. As we've got a reasonably low AUM relative to peers, we're not constrained by size. Some examples of this is maybe we look at the different pots and different areas that we invest. So one is UK equities. This allows us to invest in the full spectrum of opportunities. We have a bias toward mid-caps, which allows us to find stocks that may be uncovered or don't have the same level of coverage as the giant caps and the large caps, which helps us to be able to hopefully generate more alpha and find some really good quality companies at attractive valuations. Second element is probably on the fund selection side, so where we invest in third-party funds. We can buy the more boutique managers, the capacity-constrained products. Hopefully they'll be more investment-driven, they'll be high alpha, they'll be benchmark agnostic, and again, they'll have the full spectrum of opportunities available to them. The third area, which is again linked to size, would be our specialist assets section, which is the investment trust market. We can have reasonably significant positions in a lot of different holdings there. And again, that's our low AUM that allows us the liquidity to do that. And that provides us with extra diversification. The first bit is each individual investment. Yield is very important to us, and the sustainability of that yield is very important. So in the investment research phase, we're looking at how sustainable that yield is. Is there enough dividend cover? Are the underlying earnings sustainable? And then it goes to the next stage then, which is the diversification across the asset classes. So if we break it down across the asset classes, we've got UK equity, we've got overseas equity, fixed income and specialist. And roughly there's a third in UK equity contribution towards the yield, a third in specialist, and then a third broken down between overseas equities and fixed income. The next level of diversification is within each of those asset classes. So in the UK, we're diversified across numerous sectors. We've got some more cyclical names, some more defensive names. Then in the specialist bucket, we have a wide range of different investments, ranging from aircraft leasing, music royalties, REITs, infrastructure. So there's a level of diversification within that asset class as well. Then within the overseas equity and fixed income, we use third-party fund selection. So we have a wide array of different funds in there, and each has got diversification in their underlying portfolios. So if you extract that out to the entire portfolio, we've got a decent yield. Hopefully the underlying earnings are sustainable, and then we've got a high level of diversification across the board.